This week, I had someone post on my social media. They were responding to something I was giving information about, like low down payment and no down payment loans. And they were fearful that the loans that we were talking about were the same loans that caused the crash and all the turmoil in 2007 and 2008. So today, I wanted to take a moment and really share and educate what the difference is today when we close a loan that's a low down payment or a no down payment loan versus what it was like back in 2005, 6, and 7 before the crash. This is Recharging with Champions. And I am dating myself here today because, yeah, I did live through that. I was well in my mortgage career in 2007 and 8 when we did experience that crash. And I was doing subprime mortgages. So I really was seeing on the front end some of the things that were happening that were at the end of the day causing this rift to happen, which then, of course, caused the lovely collapse that we had, that really bad foreclosure push and appraisal issue just across the whole nation. So today I want to discuss specifically what things are done now to really help not relive that again, because there are some really good safe holds. I can't say that it's perfect, of course, but there are some really good things that have been put in place to keep that from happening again. The first one is old news. This happened years ago, but they put something in place federally. They put something in place called the Qualified Mortgage, QM, which is a rule that just says that lenders that are doing conventional financing, this is FHA, VA, USDA, conventional, Fannie, Freddie, all of your traditional financing, they must meet the qualified mortgage parameters, meaning that the borrower has to make sure they qualify for the loan. They have to make enough money. We have to do checks and balances to make sure we don't have undisclosed debts that could actually make them not qualify for making the mortgage payment. So there are very set rules in what we must document and check to make sure that that person getting into that mortgage, even if it's a low or no down payment mortgage, has the money at the end of the month to pay their mortgage. That was number one. Those checks and balances were definitely not set in place back in early 2000. We actually had something called a NINA, or a stated loan, where you just told us what you made and we would rock and roll with that. It was crazy times. So that's a big one. The second big change is prepayment penalties. So back in the early 2000s, these loans would have a 3 or a 5% prepayment penalty on them, and it would be on an adjustable loan. So let me just put this into perspective. You would have a mortgage that had a 3-year fixed type on it. So it'd be fixed for 3 years, but then it would just adjust to crazy high interest rates. But you had a prepayment penalty that would not allow you to sell that house when you couldn't afford the payment anymore unless you paid that prepayment penalty. So it could be 5% of the loan. That's huge. So you take the fact that we have people that were probably on the edge, if not definitely not qualifying for financially to buy a house, that interest rate starts to adjust and they have a prepayment penalty that they have to pay if they go to sell the house. So now they can't sell the house. They can't get enough for it. It's a really very bad storm, which is what definitely started some of these foreclosures and people in hardship back in 2007 and 2008. The last one is one that I think makes a huge difference and maybe my most important one, and that is the appraisal relationship rules. I know that realtors and lenders, we all fuss about the fact that we're not allowed to pick up the phone and call an appraiser and just tell them what we need. Well, there's good reason for that. Back in 2000, early 2000s, that is the way it was. We could pick up the phone. Our friends were our appraisers. It was they were our client, we were their client, and they really wanted to make us happy. So when it came down to it, I could pick up the phone and be like, "Hey, John, I really need this house to appraise for about $10,000 more than what you told me it was going to appraise for. Do you think you can get me $10,000 more?" And in the scope of things, that's probably not the best relationship status for an appraiser and a lender. Probably not in everybody's best interest, but that's just the way it was. Well, now there are very strict rules. We as a lender cannot give the appraiser any of the information pertaining to what we are looking like we want that appraisal to appraise for. We can't say, "Hey, we really think you should appraise it for this much." We can't give that information. The appraiser is only using the comparables, their vast knowledge of the market, and the contract to see what somebody is saying they're willing to pay for on paper. Other than that, lenders cannot disclose pull in favors or ask for value requests. The appraiser can just turn in the lender if they do. It's just like real quick and easy, like this is no good, can't do it. So there's very strict rules around the relationship now between appraisers and lenders and realtors, which is really a good idea when you think of it. We really need to know what the value of a home is. That way, if someone does have financial hardship, that value is solid. So when it comes time to sell, they know what they can sell their house for. It wasn't inflated and now they're upside down and you get all the horror stories. But basically, the loans that we have today definitely have, those are just three, but there's many, 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 many more regulations that we have now that we did not have back then. But those are the big three: QM, the fact that we don't talk to our appraisers anymore, and also the fact that we don't have prepayment penalties on adjustable rate mortgages that put people in a financial bind that they just can't get out of. There are also some really good parameters just when it comes to underwriting that weren't there before. Lots of stuff. Bottom line is, we have some good low and no down payment options today that give people home ownership options that wouldn't have them otherwise, but still put them in a financial space where they're in a good spot, not a bad spot. Things still happen, but for the most part, we're putting people into a financial up movement rather than a financial down movement like we were before. I hope this was helpful, and I hope that this gives you a little bit of peace about what the market is like right now and what mortgages are like right now. By the way, if you wanted to record something like this on your social media and just be that voice of peace and reason in the market today so that the sky is falling, maybe it's not falling. Maybe we actually do have some good checks and balances put in today to really help strengthen our economy and help homeowners get into homeownership that they couldn't if they didn't have low or no down payment options, but does it with a little bit of wisdom behind it so that more people are being put in a good financial spot, not a bad financial spot. Remember, on rechargingwithchampions.com, that's rechargingwithchampions.com, I do have a script in the May scripts. Just go download that script and use it for yourself. Read it, do your own thing, or just use it verbatim. We should control our narrative and make sure that people know the sky is not falling. Happy Monday, and we'll see you next week.